But to start with, it essentially is trying to look at what is an obvious feature of the current reality, which is that we know that for long years now, in fact, not just from the time of the global financial crisis of 2008, but from the period in which we had a set of developments which led up to the global financial crisis, there's been this huge accumulation of dollar liquidity across the globe. Uh, all of which, of course, goes and settles in the financial centers of metropolitan capitalism. And while that is the case, suddenly what we see is individual countries and growing number of them suddenly faced with a situation of dollar scarcity, not having enough to be able to import energy, to be able to import oil, to be able to keep their power stations going, or gas to keep their power stations going. Extreme shortage of dollars to be able to import food, etc., etc. So we have this situation where, if you look at it in terms of the accumulated stock of dollar liquidity in the global system, it's huge because of the fact that it's occurred over a period which stresses more than 2 decades. But on the other hand, we're faced with this situation where there are particular countries which are faced with with uh, this dollar scarcity, and I really just want to use that as a basis to make a set of points which, as I said, partly came up in the discussion we had. Now, the essential issues, of course, is that, in the past, and long time past now, developing countries were seen as externally vulnerable essentially because of the fact that the structure of the world system, the structure of their economies, their dependence on, well, traditional exports, etc., resulted in a situation where they had trade and current account deficits. And these trade and current account deficits were difficult to finance because much of the capital that they received either came in the form of foreign direct investment or came in the form of capital flows, which came through the development aid network, either the bilateral or the multilateral development aid network. They had no access to private capital markets. And therefore, in some sense, when they faced these deficits, they faced balance of payments difficulties, they had to go to the IMF and really get standby credit and then go through a process of structural adjustment, or stabilization and then structural adjustment. But more recently, in particular, it's gained momentum, is that external vulnerability is essentially post-capital account liberalization is one one in which you actually have a scarcity of access to capital, which comes because of an inability to be able to sustain legacy capital, which has poured into a lot of these economies in multiple forms, in particular, of course, in the form of equity and debt. And in periods when access to capital is available, in some sense, what happens on the current account is determined by capital movements. It's not that you needed capital account flows in order to finance your current account deficits. The problem turned much more severe once deregulation and macroeconomic policy shifts, in particular the dependence on monetary policy and the move away from fiscal policy, which was discussed earlier, resulted in this expansion in liquidity in the global centers of metropolitan capital. And that influenced the magnitude and direction of capital flows because of the fact that central banks were putting this liquidity into the market. Now, this essentially meant that if in the past the metropolis needed the peripheries as we used to say, as a market and a source for raw materials, and of course a location for drain of plundered wealth, you now are in a situation in which, since the 1980s, you need the periphery. The metropolis needs the periphery as a location in order to be able to extract surpluses by clipping coupons. Of course, now you don't clip coupons, you don't get that kind of paper, or manipulating digits, that you actually see these as sources of surplus extraction, which essentially are sources of surplus extraction which occurs through the movement of finance, and not really because of the fact that they serve or not principally because they serve as markets or as sources of raw material and wealth. Now, therefore, what we have is, in some sense, while we have one component of the neoliberal era in which we saw the relocation of manufacturing and services, the offshoring of manufacturing and services to developing countries, particularly countries which had a large reserve army of cheap labor, what we also have, in some sense, is the relocation, not completely, but a significant relocation of global finance. It actually moves into developing countries in order to be able to use them as sites for this new regime of accumulation in which finance plays a role. Now, I think in that context that we have to really evaluate how significant is it from the point of view of medium and long term analysis of the current state of capitalism and sort of challenges ahead, to really look at the COVID shock and Ukraine. And we know that what this does, it results in a loss of revenues from exports, from tourism and travel, from remittances, in as much as workers abroad lose their jobs and so on. And the problem becomes that when you have a shock of that kind, accumulated foreign exchange liabilities, which have occurred in this period in which there's been this glut of dollar liquidity, uh, become a burden because of the fact that it's difficult to meet these foreign exchange commitments because of the shock resulting in a sudden squeeze in access to foreign exchange and an inability to be able to get incremental access to capital flows to finance for periods of time what you cannot finance on the basis of the revenues you earn, which you can't earn now because of the nature of this shock. Now, of course, there are some countries which did, and I'll quickly show you after the crisis, to access to capital, because we know, for example, that now whenever a crisis occurs within this kind of a regime of accumulation, the response to the crisis is the injection or infusion of even more liquidity into the system. So in some sense, it becomes possible for some countries at least to be able to access dollar liquidity after a short period. So there was an outflow of capital as soon as the pandemic struck. But very soon, because of the response of central banks across the world, we began to see many countries, particularly the more developed among the emerging markets, countries like India, for example, at that point of time, some in Latin America, which could get access to capital because of the fact that there was this new liquidity which was being thrown into the system in order to deal with the crisis through actually precisely the same monetary policy response. But there were others which actually couldn't get access to this liquidity because they were seen now, not earlier, as being too risky because of the fact that the exposure of international finance to these countries that reached a stage where it was thought that any further exposure could actually result in even greater losses, and therefore you don't want to send good money after bad, or in some sense. Now, when, of course, in addition to this, the supply shocks which came because of COVID, the sudden stop in economic activity, not merely because of pandemic, we know, but because of the kind of responses governments had, brutal lockdowns, etc., results in a situation where you have inflation because supply chains get affected, and even a little bit of a recovery because of the restoration of economic activity, since you remove restrictions, results in a situation where demand adjusts, but supply doesn't adjust because of the fact that now supply is globally distributed, and the impact of the withdrawal of the pandemic, if you want to call it that, or the waning of the pandemic, is very uneven. So you cannot actually, unclog supply chains so easily. So if there is an increase in demand, let us say in the United States, that doesn't mean you're going to actually have supply automatically responding to the increase in demand, because there is somewhere in the world, or somewheres in the world, where actually you still have a situation in which the supply chain is clogged because there's another wave of the pandemic, as it were, so that you begin to have inflation. And that inflation, which was expected to be transient, proved to be extremely persistent, and that results in a situation where you begin to then rethink your monetary policy response. You begin to say that, listen, we cannot now continue with these unconventional monetary policies, unorthodox monetary policies with large liquidity inflation through bond buying, as well as low interest rate. But we need, in some sense, to push up interest rates, to stop bond buying. And that obviously results in a situation where you have incremental access to liquidity getting affected even more. And therefore, the countries which are not able to benefit from the pre-existing legacy stock end up with extreme difficulties. Now, I'm not going to go through this, but if you look at the impact of the Ukraine invasion, because of what it did to access to oil and food, the two things which both these countries, both Russia and Ukraine, contributed to world trade, you have a similar set of consequences in a context in which I said that you have this whole regime of accumulation in which you want to relocate finance from the metropolitan centers, not in full, but in significant measure, to the periphery in order to be able to extract surpluses in this new fashion. Now, one fallout of this, of course, is that you actually have a sudden spike in certain places of risk premium, or across very often to differing degrees. So you have 1/3 of it. This was pointed out in the case of Africa by Charles, you currently have something like a third of the emerging market economies paying more than 10% yield on their sovereign borrowing, which, given where interest rates are in the metropolitan centers, they are near zero, or in fact, in some cases, as far as lending to banks by central banks is concerned, is in fact negative. You end up with a situation where if you have 10% yield, that's crazy. I mean, that's just incredibly high. And if you take the ones in which access to liquidity has become a problem, some of the so-called frontier markets, which are seen as targets for lending, which earlier would not have been touched by global private finance, but are seen as more risky and therefore are treated as frontiers rather than emerging markets, that if you look at them, the yields there are even much higher, as was pointed out. So developing countries get hit by a double whammy in this kind of a situation. One, of course, rising interest rates means that outflow of the commitments, dollar commitments associated with international borrowing goes up quite significantly, as happened in past debt crises. And then you have depreciating currencies, which means that the local currency value of your commitments are huge. That results in bankruptcies, etc., because people are not able to meet these commitments in their own currency. Which then, of course, has to be transformed into hard currency. And therefore, you have a severe debt distress and a high risk of default. And you have the scenario which the IMF constantly keeps updating its numbers. I think one of the more recent ones said something like a third of emerging markets and 60% of low-income countries are at risk of high debt distress. The other thing which happens is, even as far as the emerging markets can get access to liquidity because of the fact that the way you're responding to the crisis is infusing more liquidity into the system, they too begin to, once you have this kind of set of developments leading up to a tendency towards unwinding of unconventional monetary policies, they begin to see outflows of capital. That is, you actually see outflows of capital. So you have this exit, and these are just charts taken from Financial Times, excepting the third one. And you can see that if you look at 2022, in the few months, in the first 5-6 months of this year, if you look at it, the light blue, which is really pointing to how much of the outflow it is, you can see the net outflow is significantly higher than what we had in most years, excepting for 2015. But it's higher even than 2015. And if you look at the increments in yields, depending upon the country, of course, if you take Ukraine, it's gone crazy. It's some 44% increase in yield. That's percentage points, 44 percentage points, not percent. And you can see many countries have got affected in terms of this increase in yield. But if you look at it in terms of, and this is the Institute for International Finance data, it's partly problematic because the only way you can get Institute of International Finance data is to either have access to liquidity. If you don't have that, you actually go to their website and pick up every month what they say is being the initial estimate, because after that you need to pay for it. But what we have here is, if you can look at it, the yellow ones are equity and the green ones are debt, and you can see that equity volatility is much greater, and in fact, the outflow is significantly in terms of equity. This is because of the fact that there are still a set of emerging markets which can go and access debt markets. There are many which cannot. I mean, Ghana cannot, Sri Lanka cannot, but there are many which can go. And in particular, if you take China as being an emerging market, something like, not half, but something like 40% of the incremental debt is because of that one country, because it can go and access the debt market. So you don't see that kind of volatility in aggregate emerging market figures when it comes to debt, because there the dollar scarcity is still unevenly distributed. But if you look at it in terms of those who want to vote with their dollars to walk out of equity markets, you can see that the volatility is much greater. Now, despite, so the point is, however, that, if you read much of the writing recently, it attributes it to the pandemic in Ukraine. And the narrative is very similar, that, you're saying that, because of the stimulus and support measures which governments had to undertake in the wake of the pandemic, partly they had to have stimulus measures, partly they had to have, cash payments to meet people who've been thrown out of their jobs and livelihoods, etc., that this widened budget deficits and increased sovereign debt. And because revenues were squeezed as a result of recession, that results in a situation where governments had to borrow more. So you ended up with this increase in debt, and it is that increase in debt which is resulting in, but as I said, you have some countries which can't even get debt, but aggregate debt hasn't really collapsed as much because there are some countries which can. and it's in the equity markets where in this particular period. But note, when we look at this, it is not during the pandemic that the exit of capital occurred. The pandemic period was not a period in which you had large exit of equity capital, excepting for one in July 21 in this set of numbers. It really is post the announcement and subsequent gradual implementation of the decision to actually move out of unconventional monetary policies. That is when metropolitan capital decides that it's not currently in a position to continue with its regime of accumulation where it wants to relocate or offshore finance in order to make surpluses from there because of the risk of losses because of what is happening in the global system. That's when you actually see the exit. It's not, so you're really blaming it on the pandemic is not adequate enough. You're really blaming it on the fact that you're finding it unsustainable to continue with that regime of accumulation, at least in this calendar year, for a significant part of the time. Now, the backstory, of course, is that we had this huge increase in pre-pandemic debt exposure from something like 4.4 billion in 2010. Once the post global financial crisis infusion of liquidity began, it went up to about $8.25 billion in 2019, or it was rising at an average of about $430 billion a year. So you have this, significant increase in debt. You had large flows of liquidity. I mean equity into emerging and frontier markets, in particular emerging markets. Frontier markets basically see bond markets active. You don't see equity markets active with foreign investments in frontier markets. You normally see it in some emerging markets. Okay. So if you look at the long-term financial background, you have crisis and deregulation in the metropolis. Because of the crisis in metropolis, they have to find a new regime of accumulation. They increase liquidity. They push increases in liquidity because they've discovered the possibilities of offshoring finance as a way of extracting surplus. There's this discovery of emerging and frontier markets. So developing countries, which earlier were considered to be too risky to lend to, that was the old way of adjustment, now actually become sources of. And then you have this tendency to de-risk these markets. Normally we hear of de-risking when? You hear of de-risking when you say public sector has to come in and put in some money and offer, viability gap funding or some subsidies in order to de-risk private investors, let's say making climate-related investments. But we have a larger de-risking going on. I mean, for example, if we take the Sri Lankan case, we know that Sri Lanka had this huge sudden, starting from the 2000s, increase in debt stocks. That's the Sri Lankan debt stock. It goes up to, I think currently, I don't know, but I think $55+ billion is the total debt stock which we have there, external debt stock. And if you look at the gross debt to GNI ratio, now the green dots there is IMF putting in money at different points of time. There are 16 adjustment programs are going. 17th one is under discussion. The discussions have been postponed. But what is the IMF doing? It is coming in at a point of time when there's excess exposure of international capital to these countries. But it comes in order to, in some sense, de-risk. It's saying that, no, we'll come in and bail out. So you actually create a situation where even though exposure figures would suggest that this country is really gone beyond the brink in some sense, money keeps flowing in. Of course, there's fluctuations. But each time, and particularly if you look at the last one there, look at the large amount which is injected suddenly because of the fact that you want to pull the inflow. You want to once again make this country a site for accumulation, for financial accumulation. So you have this de-risking which goes on. And what do governments do? I mean, governments find it, you're getting access to capital. So you begin to issue sovereign bonds. So one of the complaints about developing countries is they don't have an active bond market. It's true, they don't have an active corporate bond market, but they have a pretty active government bond market because there's a sovereign guarantee which has been de-risked by the IMF. And that's the reason why you're able to keep this accumulation process going till now, of course, when everything seems to be collapsing, as was pointed out earlier. Now, if you look at the supply side push of capital, and this is, I know it's a terrible graph, but what it's looking at is if you take the period, I'm sorry that those numbers have got confused when I stuck the chart, but this is going to the period of the financial crisis, which is where that yellow line shoots upwards, and then subsequently post-financial crisis. You can see that prior to the financial crisis, you did have that's net private flows to emerging markets, excluding China. you did have a tendency for a reasonable level of flows, and those flows began to rise just before the crisis. But at that point of time, the Fed was hardly active. That's the Fed's balance sheet. The Fed's balance sheet is flat. And then you have the crisis. And once you have the crisis, look at what's happening to the Fed's balance sheet, because the Fed is in part responding to the fact that you have that collapse in flows to emerging markets, excluding China. But because the Fed is infusing this liquidity, you're actually getting money for carry trade. You're getting near zero interest rate money. So you go and pick up this money and say, "No, come on, what are risk premia now? We can just go and buy into bonds, invest in equity markets," and you begin to see once again the flow to. So there's in fact in this period there's two segments. One is the old type of liquidity infusion, which essentially comes as a result of financial deregulation. Then you have the crisis. The response to the crisis, unlike the response to the Great Depression, I mean, after the banking crisis of the 1930s, what did we have? We had Glass-Steagall. We actually had America becoming one of the countries in which you had the most stringent regulation of finance, which lasted through the golden age, right up to the late 1960s, which is when liberalization of finance began. But here you actually have a crisis, and you don't say that, "Oh boy, we've got to rethink the liberalization of finance. We have to re-regulate finance," because that's the problem. You actually say, "No, we'll actually stimulate finance," because that's the regime of accumulation you shifted to once you faced the crisis of the 1960s. Once you couldn't actually continue with the golden age. So that's what you have there. And the result of this is that this is the accumulated legacy portfolio capital in emerging markets. This is net. So there's some coming in, some going out. How much is legacy stock which is accumulating? And you can see what's happening to that legacy stock. There's this huge amount of money, liquidity sitting in these countries. But the liquidity is now a problem, because in order to sustain this liquidity, you need more liquidity. And if you are able to get more liquidity, you're okay. But if you can't get more liquidity, you end up with a situation in which you actually, you become a basket case. You say that it's all because of bad government policies and so on. Not that government policies aren't bad, but basically we have to locate this in the context of a change in the nature of the metropolis periphery relationship, and the change in the pattern of accumulation. Now, this is okay. This is basically to say that if you really look at the period in which there's been shortfalls in terms of negative flows of equity and debt, that the green line is the long-term average. And you can see that there have been very few periods of time. There was, of course, at the time of the crisis, that's 2008, Q3, Q4. You can see it in 2015. There's a little after. It was not at the time of the taper tantrum. It was a little after the taper tantrum. And it was more recently when talk began of actually moving away from unorthodox policies. And of course, we now seem to see that is working its way through. So, if you have this kind of a thing, what do you have? You have multiple crises. So we've had banking crisis in the US in the 1980s once deregulation began, because that time liquidity was being used to lend in the metropolitan centers and not to financially globalize. Then you had the asset price collapse in Japan, the dot-com bust, the financial crisis of 2008, etc., etc. But obviously, the problem is not only of developing countries like the Mexican debt crisis or the Southeast Asian financial crisis, etc. It is a problem wherever, whether it's the metropolis or the periphery, wherever you're not able to continue to sustain this process of actually bailing out finance each time it runs into a crisis. And therefore, you have this crisis, but if you can bail it out, fine. So the question is, if after 2008 you could bail out the way you did, are you going to be in a position to bail out now, where exposure has reached such a large level, both in the metropolitan centers, and you have these two major shocks to address, the consequences, the COVID and the Ukrainian shock? Are you going to be in a position to be able to pull, in some sense, can finance sort of stand up and pull itself up by its own bootstraps with the help, of course, of the Fed and the Treasury? So you basically, how am I placed on time? Oh, okay. So what's the overall consequence? One, of course, is the debt fallout. The access to debt is substantially increased, but the adjustment to debt, whenever there is a debt, which only increases debt dependence because of the way in which, in the new world of monetary policy dominating over fiscal policy, the way in which crises are handled. And the intensification of neoliberalism obviously increases debt and shrinks policy space, etc. And in terms of borrowing from private sources is concerned, that begins to increase. So you're not stuck to accessing capital through the development aid network. You can actually, pick up a phone and call, whatever, Frankfurt, Paris, London, city of New York, whatever it may be, and New York City or city of London, etc. But that obviously creates a situation where you have multiple lenders, and because of the fact that you're operating through the issue of bonds. It's really through the bond market. And if you have multiple lenders with differential exposure, obviously it becomes difficult to restructure debt. So the old way of resolving the crisis is in fact undermined. You're not able to actually reschedule and resolve debt because there are too many people who have to come and sit at the table and agree. That's a problem in Sri Lanka. Nobody is talking about the fact that one of the reasons why you actually couldn't resolve the problem when it should have been resolved, have said that, listen, okay, we'll come, but we can't come immediately because of the fact that we already have a problem with you having done it 16 times earlier. But it's also because of the fact that a significant amount of the sovereign bonds is held by private players, including BlackRock and so on and so forth. So it becomes difficult to restructure, okay? And if you look, of course, at portfolio flows to equity markets, then, in the more developed equity markets, the story is not about debt, it's about portfolio flows. But there also there's this problem of the outflow. So what's really is the current impasse that, in this whole regime, basically you found ways. And of course, one was, of course, the use of derivatives, which actually tried to create the illusion that you could actually bundle together different kinds of risks and offer it to investors who are very dispersed, because, you had equity investors dispersed, you had bond investors dispersed, such that therefore the average risk which an investor held was so low that you're not going to have a systemic crisis. Somebody might lose money, but not everybody's going to lose money at the same time, because you have this very diverse set of bundles, with which derivatives have been created. But obviously that's proved that proved to be completely wrong in 2008, as far as the crisis in the sort of in the Atlantic area really it showed up. That once you have exposure, let's say, to the housing market, which goes beyond a certain point in terms of below par, below premium lending, then obviously you're open to a crisis which is systemic, and that's what happened. Even though you had all these derivatives which are supposed to distribute debt, and finally you had So what you're saying is that what I want to say is that the Wall Street Treasury Federal Reserve nexus, this is not a conspiracy. This is an essential component of the post-1970s accumulation regime. And what you're actually having now is a situation in which that has progressed to a point where 2008, everybody thought was the end of that game. But you could, by actually allowing the Federal Reserve's balance sheet to move from 800 billion to 4-point-something trillion. And then you thought, oh, now can the Federal Reserve keep actually increasing its balance sheet by buying up bonds and infusing liquidity to save financial capital? And then what do you find? We now know that because of the way in which you've dealt with the other crisis, from about $4.25 trillion, you've now gone to what, $8-9 trillion is the balance sheet of the Fed. There doesn't seem to be any limit on the flexibility of the Fed's balance sheet, but obviously there is a limit, and that limit is now asserting itself, because once you go into exposures of a certain level, this kind of a regime cannot continue. And therefore, maybe this crisis is indeed different. It actually is not going to allow you to actually even do what people thought you wouldn't be able to do in 2008 to get out of it. Thank you.